Hey traders, this is Blake Morrow with Trader Summit, and we're going to bring in Jim Welsh. I know it's not Friday, but because of me, and I couldn't meet with Jim this week, we're bringing Jim Welsh from Macro Tides early this week, and we're going to talk a little bit about the markets and about some of the price action that we've seen. How you doing, Jim?
I'm doing good. It's Monday and I'm
It,
lost.
it is Monday. I'm so well. Let's hold on there because
Yeah,
I
yeah,
think I think you got some. I think you got a lot of information that we want that you want to cover. But I want
yeah,
to ask you, like, how do you feel about the price action that we've seen in the markets? We've seen a little bit of a downdraft. We've had almost a 7% correction from the highs. How do you feel about everything, and why do you think the market's on shaky ground now?
yeah. Well, I'm not surprised. My expectation was that we were set up for a 5 to 7% pullback. We talked probably over the last month about key reversals and major market averages, including stocks like Nvidia. And there were key reversals on March 8th, April 4th, and then April 15th for Nvidia and the S&P and the semiconductor stocks. So what we saw last week is finally Nvidia breakdown on Friday. It was down 10%. So to me, it just shows the shift in sentiment in terms of, gee, you can't hide here anymore. And when that realization kind of dawned on a lot of people, we saw kind of an overreaction. I think there's more weakness to come in that area because it's like the sentiment shifted. Netflix, for instance, came out with good earnings, hit all the metrics. I think the stock was down 4%. So it just seems like that shift has taken place. There's a lot of earnings coming up in the next week. And I think my guess is that people are going to be more inclined, if somebody comes out with good news, to do some selling into that good news. And obviously, if anybody disappoints, they're going to get hammered.
Okay, now that brings up maybe my next question. And I know we're going to go into your charts here, Jim. But do you think that we've seen a near-term top in the markets? Do you think we start selling rallies, or are you just looking for levels to get long again? And again, I
Yeah,
will say that I know you're going to be giving us this information, but gut
yeah.
instinct, how do you feel right now?
I think we're oversold enough to get a bounce. And then I think there's another leg of decline coming. In other words, this decline was maybe wave A. We get a bounce for a B, and then I think there's another leg down coming before May, June-ish time frame. And then that next rally, if it unfolds that pattern, will be, to me, very, very instructive in terms of what we can expect for the balance of the year.
All right, and I don't want to give away the charts that you are you to talk too much about them because I know you brought charts to accompany those
Yep.
ideas. So we're going to get into some of your thoughts about that you brought to the table. And
Yep.
I'm going to say this before we get into the all of Jim's views and all the macro and then technical points of view he has about the markets. If you enjoy what Jim does, make sure you give him a big thumbs up. Subscribe to the channel down below. And make sure you reach out to him. We'll talk about that at the very end. Make sure you reach out to him so he can provide you the most recent
Publication.
publication. There you go.
It's
Or
Monday,
edition.
man. It's Monday morning.
It's Monday morning, and I'm working on a few hours of sleep. So, Jim, let's get into some of your
Okay.
charts. Let's talk about this
So,
curve.
yeah, one of the concepts, we've talked about is that even though we've had higher rates, the market has been able to shrug it off up until, last week, higher rates started to play a role. Because the idea being is, okay, we thought we were going to get 6 rate cuts, but, if it's even only one or two, it's all right just because the economy's okay. So what this is showing Wall Street economists, as we can see in 2022, everybody thought the economy was fine early on, and then we got to mid-year, and the expectation was 63% thought we were going to have a recession. That is now down to 29%. So for me, what this suggests is that any meaningful slowdown in the economy is going to come as a shock because that has been the pillar. First, it was rate cuts plus the economy doing well. And then they've been just putting more chips on the idea that the economy is going to avoid a recession. And as long as that's the outcome, we're okay. And I'm a contrarian. So when you have everybody back in 22 and 23, we're looking for a recession. You and I had many conversations. I did not think a recession was going to happen. I think at this stage of the game, we are approaching an inflection point as we get to mid-year and beyond. I think there's going to be more signs of slowing. And I think the next chart kind of is one of the reasons why.
But Jim, before you go into this chart,
Yeah.
I've since I've been interviewing you literally for the last couple of years, almost on a weekly basis. You say you're a contrarian, but I think you are a contrarian, and correct me if I'm wrong here. You're contrarian by idea, but it doesn't mean that you go against the grain all the time. Matter of fact, you go
No.
with the direction of the trend quite a bit, but always
Yes.
staying more cautious or on guard. Is that correct? Is that a correct statement?
Yeah, absolutely. I mean, to me, this is where technical analysis can be very, very helpful in that, all right, gee whiz, I think something is going to happen. But like in 2022, the technicals remain negative. When we got to October, like, okay, everyone's pretty negative. I think we're going to see a recovery. I think we're going to see treasury yields come down, the dollar topping. Same thing happened in October of 2023. So to me, combining fundamental and technical analysis with contrarianism being an idea of when does it get to be the time when you have to start looking for cracks in whatever the narrative is. You know, if everyone's negative, you got to start looking for cracks in that narrative because you're likely to see cracks show up. And when that happens, that's when you get the biggest moves in the market, as you know, Blake, is when everyone is leaning in one direction and it proves incorrect, you get a bigger reaction.
Sure.
So right now we've got everybody on, I shouldn't say everybody, but a majority of people are pretty convinced that we don't have to worry about a recession. This chart goes back to 1920, and it shows the days of inversion. So it's not just simply, okay, we got inverted. But what this chart implies, and the numbers in the table show, is that the longer an inversion persists, the more likely are you're going to not just get a recession, it's going to be deeper than average. And, you know, you can see, as I've shown here, we're at 537 days. You know, look at 2008, 73, 74, 80, 81 was kind of an interesting time period, but still you had two recessions. 82 was a fairly deep recession, as opposed to shallow recessions that happened in the other years. So my point is, and we've talked about this, you have financial conditions created by market averages. So the S&P rallies, financial conditions ease, treasury yields come down, financial conditions ease, the dollar weakens, spreads between corporate and treasuries narrow. All that lists financial conditions. But on Main Street, financial conditions are still very, very tight. And so that's my point. The longer an inversion lasts, slowly but surely it begins to infect a greater percentage of the economy and causes a pullback in spending by small businesses and hiring by small businesses. And ultimately, that contributes to higher unemployment. So this is the National Federation of Independent Businesses. And what it shows is, well, where's sentiment? Well, other than the financial crisis in 2008, we're at the lowest level since 1985 or 86, whatever the number is, right? So my point is, if you're a small businessman, you know, yeah, bond yields came down for a while. You didn't benefit from that at all. You know, housing activity picked up a little bit because mortgage rates came down. Well, now they're back to 7.5%. Well, last month, existing home sales were down, I think, 4.5%. So my point is, Main Street is still carrying the full weight of where policy rates by the Fed have been lifted to. And the longer they stay there, slowly but surely, they're going to drag down economic activity. And we've had a number of special factors in this cycle that have, I think, stretched some of the rubber bands on this regard. You know, excess savings, government spending. You know, government ran a deficit of 6% last year. GDP was up 3%. So what does that tell you about the private economy when government spending is twice what growth was?
Yeah.
So, you know, these are the special factors. But and you know, huge rally in the equity market since last October. Housing prices, as we've known over the last 2, 3 years, increased very significantly. So there's a wealth effect on the top 40 or 50% of earners, if you will, in this country. And some of the spending that we're seeing is the result of people feeling pretty good because their house value went up by 30, 40%. They got an equity portfolio that has jumped a lot, So again, this, to me, the message here is the longer an inversion persists, it weighs on Main Street. And I think as we get to mid-year and beyond, we're going to see those downward pressures become more evident.
So, and which is also really interesting because if you have, you talk about like the American economy and a lot of people's balance sheets. Look, if stocks don't get completely wrecked, or if home prices don't get completely wrecked, aren't the balance sheet of the American people not in bad shape?
No,
If
well, again, for now, they are in good shape. I mean, that is the reality we've been living
yeah,
over the last 6 to 12 months. Um, I think once the economy slows, it's going to have an impact, obviously, on equity prices. As I said at the beginning, the market's been able to rally after January because this belief we weren't going to have a meaningful slowdown or a recession. If one materializes, I think equity prices get hit. People, I'm going to probably write about this in the May macro tides, because historically the concept is, well, when the Fed cuts rates, the market goes up. Well, wait a second. If the Fed cuts rates because the economy is going into a recession, historically, the market has not done well. If that's the cause. Wall Street believed at the end of last year that the Fed was going to cut rates, not because the economy was in bad shape, but because inflation had come down. So to me, that, again, if we start seeing some rate cuts because of economic weakness, I think there's a bout of selling that happens in the market, because that has been one of the foundation pillars of the market. Hey, we don't have to worry about the economy. People start to have to worry. All of a sudden, I think you see some weakness, and that would be my guess. Next year, more and more, Blake, I'm thinking next year is going to be a very difficult year because I think the economy is going to be definitely weaker. Commercial real estate problems are going to really resurrect in a very meaningful way. And if unemployment ticks higher, guess what's going to happen to consumer spending? So,
yeah,
you know, again, it's like we're getting there. We're just not quite there.
All right.
Yeah.
Well, you go on to talk a little bit about small
Yeah.
business hiring plans. So let's discuss that, Jim.
Yeah. Well, just very, small businesses, those with less than 20 employees, create more than half the jobs in this country. So, what's interesting, Blake, is everyone now is pretty much, we really don't have to worry. The labor market's held up unbelievably. And so now on Wall Street, they're projecting that employment gains are going to persist at a very, very high level. And that flies in the face of what this shows is that small businesses are scaling back hiring plans. And again, are high interest rates and borrowing rates playing a role? I think so. I mean, you're borrowing money at 10 to 12% as opposed to 5%, which was the case 3, 4 years ago, makes a big difference in terms of your bottom line.
Sure.
So what this again shows is another indicator that labor market strength is likely to fade. And again, that has been one of the things that those bullish on the economy have continued to point to, understandably. I mean, it's a legitimate thing, but that's all backward looking. This is the kind of stuff that says, okay, where are we going the next 3 to 6 months?
Well, let's talk about how it's going to affect markets. So you have the S&P. We discussed it a little bit here.
Yeah.
It looks like you got a little bit of could go either direction from here.
Well, here in late March,
okay.
I basically said we're at a very interesting place because you had 3 waves up from the low in October of 2022. That low by the capital A, and with 3 waves up, 1 or 2 things are going to happen. But in the near term, both paths implied a decline. So if it's bullish, we were going to have a decline of for wave 4. So the rally into March, April was wave 3 off the October 22 low. We were going to get a wave 4 pullback, which is the green line, and then a rally to a new all-time high. That was the bullish count. The bearish count is you got 3 waves up, A, B, C into that high of B, and 3 waves up is more bearish. We're going to get a deeper correction off of that. So to me, it was like it's time to lighten up because both paths imply a pullback. And we've seen the beginning of it. And as we said at the outset, I think the odds are it's not done yet. I mean, the degree of bullishness that existed in March going into April was extremely high. And it just takes time to wear some of that off. So, again, this is the path that I think the market is on. And even if we get a bounce and then go down, it could still be ABC for 4, and then you go up to a new all-time high. So, wave 2 last summer from July to October, that was about a 10% decline. So my point was, if wave 4 is similar to that wave 2, you're talking 7 to 10% ultimately for a pullback.
Well, Jim, you got the next
ultimate new highs. Yep.
Yeah, the next chart you brought is the market breadth. So explain to us what we're looking at here.
Okay, the bottom panel shows a 21-day taking advances minus declines and using a 21-day moving average on it. And whenever it gets down near minus 400, which is the green vertical line, you're oversold. And what you can see is last September, October, is set up beautifully. You had a low, a bounce, and then it went to a lower low, and the AD line oscillator hit a higher low. So that was one of the divergences that I looked at and said, you know what, we're getting set up for a rally. The fact that it got so oversold now, last week, to me suggests we're going to get a bounce. The interesting thing, at the last 2 days of that bottom panel, you can see how the oscillator ticked up. On Friday, the S&P was down, I think, 8 or 0.9%. There were more than 900 stocks up versus down. So underneath the surface and the weakness on Friday, Blake, there was buying coming in. The Russell was up, the equal weight was up, kind of foreshadowing that, all right, we're getting near the end of this correction. They've finally gotten around to hitting NVIDIA and some of the other leading tech stocks, which for some people is like, oh no, now they're breaking. That means, oh, we're really going lower. To me, it's more like they finally broke them. Now you're ready for a bounce. The strongest ones just gave up the ghost, but underneath the surface, we were seeing the market starting to show some internal strength. So that's one of the reasons why, there'll be some bobbing and weaving this week. You got the GDP number coming out on Thursday, should be north of 2%. The PCE, the headline is going to tick up by 1 or 2 tenths. The core may drop from 2.8 to 2.7. So I don't think there's anything definitive that would lead anybody to think that the Fed, that data is going to be really embraced by the Fed. It's going to reinforce that economy is still chugging along okay. Inflation, even if it ticks down a tenth on the core, but it ticked up on the headline, isn't really going in the direction the Fed wants. So I think this is going to be choppy near term, but ultimately I think the market's set up for a rebound. Retrace half of what we just saw of a decline. So,
well, let's see what how you feel about yields, because yields still look really strong. TLT looks, obviously a little weak here. So, what are your thoughts?
Well, my thought is that we're approaching the end of the correction that began in late December. Going back to from last October, you can see 1, 2, 3, 4, 5. And then the red letter A. So to me, that suggests that the intermediate trend in bonds is up. But in late December, it was like, we're going to have a pullback. And the 618 is at 83 or 86.30, pardon me. The 618 was 89 something. I can't read, but
89.35. Yeah.
Yeah. So we're getting there. In terms of a pattern, I think you can see 1, 2, 3, 4, and I think we've got one more lower low coming. We'll be on the PCE number or whatever. So my take, Blake, is I think we're near a trading low in bonds. If correct, it implies, TLT rallied about 18 points off the October low. If it bottoms near 86, 18 points gets up to, 104. My take has been, I think 105 to 109 is what we're going to see. And we're just not there yet. You can see the green and red lines. That's the 5 and 13 exponential. So, if we go to a lower low, the first thing the TLT has to do is get back above that lower declining trend line, get back into the channel it was in, and then have the red line cross above the green line. So that's, what we obviously need is, oh, Jim, this is all wonderful, but at some point in time, you need the momentum
Yeah,
to actually
it's
reverse
like
and show
you
strength.
you need A and B to happen to get C, and you're
Yeah,
and it's putting it all together.
yeah,
So with the dollar's been very, very strong.
yeah.
But today it's obviously a little weaker. Stocks might have been oversold. Dollar looks like it's trying to come back a little bit, but it still looks pretty bullish, Jim. How do you
Yeah.
feel about it here?
Well, again, when we talked a week ago Friday, my take was the CPI was going to come in hot. The dollar was going to get a boost from that. So I thought we would get to a higher high. And as we discussed that time a week ago Friday, if you do some measurements, that 106.62 is where A and C from the 102.35 would equal. And then from the low from 162 to 104.97, that A to C comes in at 106.71. So my take here is I think we're getting near the end of the rally that started in late December. And again, when we talked, we were positive about the dollar based on 6 rate cuts ain't going to happen. And that would be a tailwind for the dollar. It's come to pass. And, I think there's a little bit more strength, and then we're going to see weakness. And part of that is also predicated on the idea that the economy is going to start to show signs of slowing as we get to mid-year and beyond. And so all of a sudden, if that proves true, there's a window of time where rate cuts start to, oh, wait, we're only going to get 1 rate cut. Oh, maybe we're going to get 2, Now,
Yeah.
here's the one thing I will mention that I think is important is that the inflation data has pushed the rate cuts back. Powell's been forward, well, it may take a little longer. They want to see some weakness in the economy beginning to appear, which means, Blake, at the first signs of slowing, they're not going to rush to be cutting rates. It'll be like, finally, we've had the funds rate at a restrictive level. It's actually starting to cause the economy to slow down. That should start to give us some help and relief on inflation down the road a piece. And so my point is, I think, from the equity standpoint, the first signs of slowing in the economy, the Fed's not going to be rushing to cut rates. And I think that's an environment that proves problematic for stocks.
Yeah.
We'll see.
Yeah. Okay. Well,
But also it would be, again, a reason for the dollar to decline. And I think the dollar is going below 100 at some point in time in this year.
all right. Well, you're going to stick to that idea. Gold
I'm
is
Irish, man. I got a flat head.
the gold has been, I fail to find reasons why gold should be going down. And it seems like the rest of the market feels that way too. And that means that we're probably about ready to start going down, but who knows? Anyway,
Yeah.
but what do you see? I just throwing that out.
Yeah. No, I mean, I think you got partly why it's going down, and I think is a little surprising from a standpoint it's been acting so well in the face of higher yields, in the face of a stronger dollar, almost impenetrable. But that engendered a lot of optimism. So sentiment surveys show a lot of people have become pretty bulled up. Last week, ironically, Goldman Sachs and I think 1 or 2 other Wall Street outfits, they raised their targets to 2,700. So it's hard not to okay, now it's time to fade, because when they come out, obviously the trend is so well entrenched that it's time to look for a pullback. When we talked a week ago Friday, my expectation was that we would see a pullback to the 2230, 2260. And I think there's an outside chance you could get down closer to 2200. That's the 50% retracement. So I think there's a pullback coming. And then I think the odds are, if I'm right about the economy slowing and prospects for Fed easing will pick up as a result of that, I think that's the tailwind for the next move up in gold. So I'm still bullish longer term. I just thought, hey, it's come awfully far very quickly. Time to take money off the table. And I was a little early in terms of doing that, but I will acknowledge. But just because, I got in at a good price, got out at an okay price, and it kept running. But to me, it's so easy to make that additional mistake of, oh geez, it's running. I got to go grab it. It's like, okay, just be patient, wait for it. It will come back. And I think that's what's coming. Gold also, my guess, Blake, is down, up, down. Because a lot of the bullish people who missed some of the rally, man, this first dip, thank God. So you get a bounce, and then you get another leg down. You hit some stops under that first low, and then that kind of helps really reset sentiment where it's more even balanced.
Yeah.
That would be my guess.
Shake some of the weak hands, Jim. So
yeah.
Sometimes the market has to do that. All right. Well, Jim, I appreciate you catching up with us at the beginning of this week. And I know you're going to be catching up with us at the end of the week too. So people are going to be really excited to do that.
Really excited.
But if you want more Jim in between now and then, what's the best way to get a hold of you?
Macrotides.com. Send me an email, Jim Welsh Macro at Gmail. And I'm happy to send out a most recent publication.
All right, Jim. Well, we do appreciate you, and we appreciate you being here. And I look forward to catching up with you on Friday. And if you all enjoyed this episode of Jim and I together on Trader Summit, make sure you give him a big thumbs up and comment down below if there's something that maybe you want to debate or maybe even add to what Jim has to say. So we'll look forward to seeing you on Friday, and we'll look forward to hearing your comments down below.
All right. Thanks, Blake. Have a great week until Friday.
Thanks, Jim. You as well. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.